So I'm looking forward to talking to you guys today. I've been a professor at Columbia for 15 years, and somehow I've avoided giving a free lunch for a long time, and then Paul was down the block and recruited me to give one this year. So I'm happy to do it, and looking forward to talking to you about some research I've been working on. So just to sort of set the agenda a little bit, increasingly, many financial markets are operating 24 hours a day. So they open sometime Sunday afternoon, and then they close Friday afternoon. And the old idea of things open up at 9:30 and close at 4 o'clock, while it's true to some extent for even things like single name stocks, increasingly it's no longer true. So there's pre-markets, there's after-markets. And for all of the large global macroeconomic markets, what I would say are the really important ones: stock index, and stock index futures, currencies, bonds, commodities. They trade 24 hours a day, effectively a 2-day stop from Friday night till Sunday night. And this is a recent development, I think, due to two things. One, globalization. So worldwide shocks are more important than they used to be. So for example, about 50% of S&P 500 sales are abroad. So market cap weighted stocks, 50% of those revenues are coming from outside the US. So naturally, information about China, Europe, other major global markets is first order for valuing US firms and understanding what's going on with US firms. If you look at the news over the last couple months, things like Chinese manufacturing and services have dominated US markets, not just Chinese markets. Earlier today, there was an announcement that Norway's sovereign wealth fund is going to start liquidating portfolio holdings. They hold a valuated, effectively, index of global asset markets. Half of what they hold are US asset markets. So these international developments, this is probably a slow trend that had started many years ago, but really accelerated in the early to mid 2000s. At the same time, you had, and it goes by different names, automated, algorithmic, high-frequency trading. So while we're sleeping, previously we would have had to been awake to do the trading, but now while we're sleeping, machines and computers can execute our trading strategies. So instead of having a trading floor with people on them, we now have machines. So you interact these two, there's a huge amount of news that affects US assets and global assets that doesn't occur in traditional trading hours of the locality. Combined with now sort of technologically, we can trade 24/7. And what this means is that we have effectively new markets, or we can now trade things at times and in places that we couldn't have before. And this is just a picture, nothing special about this. This is a picture of S&P 500 futures earlier this week. So last week there was a Fed announcement, and then this was Sunday night, and then this is now 24-hour data. There's a 15-minute trading halt from 4:15 to 4:30. Currencies trade 24/6 without any trading halts. If it's traded on an exchange, they do a short halt to sort of restart the systems. As part of this development coming out of automated trading, there's a lot of things that have happened, and you often hear people referring to this algorithmic automated trading as a villain. So I did a quick Google search for a few quotes. Michael Lewis's Flash Boys book, which if you haven't read, you should read. The market is rigged. High-frequency traders, these are not all from Michael Lewis. High-frequency traders are not interested in the fundamental worth of a company. They're interested in making a quick killing and moving on. They're a dark force against ordinary human traders and investors. It's like the wild, wild west. And then you hear all these nefarious terms: spoofing, electronic front-running, flash orders, latency arbitrage, quote stuffing, all sorts of other things. And all this stuff may be true. And I don't want to get involved in the debate. And you often see pictures like this. So this was a flash crash in Charles Schwab a few weeks ago. It's important to note there's some clear benefits of all this automated trading. And I don't want to get into the discussion of whether we need to do it at milliseconds or microseconds. Regardless of the speed at which it happens, there's some clear benefits. One is we now have price discovery. So one of the main uses of financial markets is just let the market do the digesting of the news. We don't have to read all the news stories. The market will tell us what's important, and it'll impound all the relevant information. So now, instead of waiting for 9:30 when markets open, we now know what's going on 24 hours a day. There was an interview with Mario Draghi, and they asked him, what was the first thing you look at in the morning? And he said, I look at the S&P 500 futures market. Wakes up, grabs his BlackBerry, looks at the market. Why? That tells him what's happened in the world. Markets are up a lot. That tells him something probably about economic information. If they're down a lot, it tells him something. And this is a clear benefit of, I think, this automated trading that's happened over the last 10 or 15 years. So you get price discovery now sort of all the time. You also get a very rich and high quality data source. And that's what this research is going to talk about, which is how can we use this high frequency data to build models and to try and understand the drivers of market risks and to use for forecasting applications. Okay, so what I want to do now is just sort of walk you through how we think about doing this. This is a large portion of what we as academics do. We build models trying to understand what's going on in the world. So we're interested in a number of questions. Things like, what are the factors driving high frequency price variations? Are these factors different in some fundamental way than what's going on at lower frequency time horizons? I think some people think that there's something really weird going on at high frequencies that's fundamentally different. We'll argue that's not really fundamentally different. It's the same stuff, just operating at a different time scale. And in particular, we're interested in kind of like accounting exercises. Suppose you woke up in the morning and S&P futures were down 40 points. This happened a couple times in August. What does that mean? Is this in some sense normal? Well, maybe markets were very volatile in August, so being down 40 points shouldn't be a big deal. Or was there something that really signals that this is a very large abnormal event? And then if it's abnormal, we want to try and understand what's going on. And that's one of the things that combinations of models and data allow you to do. How important are things like announcements, these flash crashes, very rapid moves? Are these things, while we read them in the news, they're really not that important in some overall sense? But in particular, this is how news gets impounded into prices. So when a GDP report comes out, or last Friday a payrolls report comes out, and markets move very rapidly. Okay, this wasn't the FOMC, this was payrolls last Friday. Okay, so the S&P drops 40 points like that, and then sort of fully recovers. How important are those types of movements? If we think of these old debates of how rational markets are, and are the fluctuations in markets due to fundamentals versus other stuff, looking at higher frequencies and looking at things like announcements are really important. Can our models, or can the same models that we use on a day-to-day basis, capture periods like the financial crisis in 2008, 2009, when you had just sort of unprecedented movements? So are these sort of differences in kind, or are they differences in degree? Is this a period that's like all others, except for maybe it's a little more volatile, or is it fundamentally different? And we'll argue there's nothing really fundamentally different about them. And then can we use this newly available data for real-time exercises that are of interest to practitioners, things like forecasting, risk management, or some simple trading applications. Now, it turns out, addressing all these questions, when we think of models running a regression or building distributional assumptions on data, on the one hand, it seems like a relatively simple exercise. We do it all the time in our statistics classes. It turns out some of the features of higher frequency data make this very difficult. So when I started off on this research agenda, one of the first things I did was, let's look at what other people have done. And it turned out that basically nobody had done it. Nobody had taken and built models using high frequency data. So why is that? So why have people not tried to build models using higher frequency data, whereas there's tons of models using things like daily stock return data? So the first is due to the first reason is the intricate structure of the data. You really have to be careful when you start using high-frequency data. There's very strong periodic or seasonal patterns throughout the trading day as the sort of global migration of trading occurs. This is a picture of take 5-minute S&P 500 futures returns, okay, across the day, and square all the returns in a time bucket, say from 12 to 12:05, average those across all days, and look what the pattern looks like. Okay, so here's the traditional trading day. This starts at 9:30, okay, ends at 4 p.m., and there's what's called the U-shaped pattern of volatility. Markets are more volatile at the open, okay, and at the close than during the middle of the day. But you see the same pattern. Here's the open of Europe to some extent. Here's the open of Japan. Okay, and then there's X's here for times when you commonly have economic announcements. Okay, and these are the volatility at those times where those X's are. So you see a big spike in volatility at 8:30 in the morning. That's when things like payrolls, announcements, inflation, and things like that are released. So if you want to start thinking about modeling, all of a sudden you're immediately confronted with this, which is a return coming at 2 in the morning is at some level extremely different than a return coming at 10:15 in the morning. Okay? And this is going to be a first order effect when thinking about building a model. Okay? One layer of complexities. So there's these intraday patterns in volatility. There's also interday patterns. So volatility has a well-known pattern over time, which is it's very persistent, but there's these long periods where it goes up. Okay, so this is starting from 2007. This is the financial crisis. Right, so we had elevated volatility for a few months. But notice we also have periods of months where volatility is very low. And if we think of the last 6 months, it's a perfect example of this. Last spring, markets were extremely quiet. And the last 6 weeks, markets have been extremely volatile. That's sort of a well-known pattern that repeats over time. You don't exactly know when it's going to be high or low, but if it is high, chances are it's going to remain high tomorrow. Okay, so you have these intraday dynamics, interday dynamics, and then you have very complicated distributions of returns. So here's a picture in stats. You guys draw histograms of data. This is the histogram of 5-minute S&P 500 around-the-clock returns. Okay, that does not look like a normal distribution. There's lots of zeros, extremely fat tails. Here's a QQ plot, which I think you guys are familiar with. This is about as degenerate of a time series of data as one could possibly imagine. A statistic like the raw kurtosis is something like 200. And that's because there's lots of zeros and things close to zero, and then lots of observations deep in the tails. There's also issues with just doing statistics. So when you have high-frequency data, and 5 minutes isn't really high frequency, you have 370,000 observations a year. So we have a 5-year data set, post-2007. That's in the millions of observations already. You can't really load those things to Excel and do anything with them. So combinations of complicated dynamics, strange return distributions, and huge amounts of data make the exercise very, very difficult to do. And I think one of the reasons people haven't looked at this is the sort of complicated data and huge data sets have prevented the application using standard tools. So what I've done with a co-author of mine who's a statistics professor is we have a very refined, powerful toolkit of statistical methods that we use to build models and to analyze those models. Which gives us sort of a big research edge in that we're able to analyze things and do things that others wouldn't because of these sort of computational and algorithmic advances that these computer programs and libraries that we've built. So how are we going to think about building a model of high-frequency returns? So as is common, we take log returns. So log changes in price over a 5-minute period. And then we're going to this is some constant mean, can ignore that over very short time frequencies. We're going to have 2 components. Okay, this is going to be sort of the normal fluctuations. These errors in a base case will be normally distributed. And then there'll be some volatility. Okay, so you can think of V moves up and down. Okay, taking these normal kind of day-to-day fluctuations or minute-to-minute fluctuations and scaling them up or down. So in periods where volatility is very high, this will be high. In periods where it's low, it's lower. And then over here are sort of abnormal movements. Okay, we could call them crashes or jumps or something really out of the ordinary. So this is kind of ordinary or normal fluctuations, and these will be abnormal fluctuations. We're going to allow not only for these things to be normally distributed, but distributions that have fatter tails, things like t-distributions. But when we think of sudden, very large or very unexpected movements, they're going to be coming from here. These are going to be largely the normal expected types of moves. Now, one of the key innovations and sort of a crucial modeling component is having a model of volatility that captures these things we saw earlier. Okay, so for instance, volatility at 2 in the morning is very different than volatility at 10 in the morning. Volatility when there's an announcement is very different than when there's not an announcement. And then volatility dynamics over time, volatility changes quite a bit over time, so that has to be incorporated also. So we're going to have a specification of volatility. It's called a multi-factor specification, where there's different components. And this is one of the things we struggled with, and we were able to eventually to come up with a relatively simple but realistic specification where there's 4 different components or factors driving volatility. So A stands for announcements, S stands for the seasonal component, that time of the day pattern. XT2 is a fast volatility factor. Think there's news intraday, okay, unemployment report, markets become very volatile, but then it digests it relatively quickly. And then this is sort of the very slow-moving secular movements in volatility. 2008 was a volatile year, but 2006 was a quiet year. Something that's going to be operating at very slow frequencies. And although this model looks relatively simplistic, we kind of have normal and abnormal movements. Once you move down here, you see that it's a relatively complicated specification. So there's predictable stuff like announcements. We know when those are going to occur. Time of the day is also predictable. We know when that's going to occur. And then there's these slow and fast components. The slow and fast components have sort of a standard specification. The slowest is what's called an autoregressive component. So this coefficient is like 0.99, which means that if volatility is high today, volatility tends to be high tomorrow. But over time, it mean reverts back down to some base level. Okay, this is not something, while this could operate intradaily, is not really going to be moving at an intradaily frequency. It's going to be daily or weekly. Okay, and this is one thing we are surprised at. When you look at high-frequency data, 5-minute data, this process looks almost identical to the same process that you would estimate if you looked only at daily data. So that's the sense in which there's nothing really fundamentally different about higher frequency data. It kind of has a lot of the same information. So this is a slow-moving factor, and then we have a fast-moving factor. Okay, and this fast-moving factor also has sort of normal shocks to it, and then abnormal shocks. So what do we think of these abnormal shocks? Think of some unexpected news announcement. Okay, some Treasury Secretary or Fed speaker gives a comment on CNBC. Nobody's really expecting them to say anything. They do, and all of a sudden markets really move. Okay, or a news leak during the crisis of a Federal Reserve program that's going to be announced in a few days. Somehow it got leaked out early. And what will happen is this term will crank up uncertainty. Okay, so these abnormal movements, these are all positive. And then it'll slowly digest and mean revert back down to a normal level. But it's something that could last for minutes or hours or even days. This one, think days to weeks. This one, think minutes to hours. Okay, and then already we have a relatively complicated model that allows us to capture many different dimensions of market movements. Okay, we also specify a seasonal component using a thing called a smoothing spline. It's like a nice smooth function that has breaks at the open and close. And then we have announcement effects, and I'll show you what those look like. One of the big problems with doing statistics on a model like this is none of these things are observed. Right? So you're really estimating the parameters that are driving these things, but you're also trying to estimate all these state variables. And that's where the need for really complicated econometrics and statistics comes in. I'm not going to bore you with that. It's very complicated and very boring, but it's also very useful. And if you want to get a PhD, you can spend the next 5 years of your life learning these things. Some model labels for models. I'm not really going to talk through this. I think increasingly one way of viewing how models fit is to watch how they behave live, sort of as you roll them through the data. Often we use statistics like an R-squared, which is a summary of a fit over an entire data set. Okay? But you can also do, for time series, sort of period by period fits. Which one of the models fit the data well for any given period? And we introduced in this paper some metrics to do sequential model monitoring. On the left side is how the models performed in sample using the data, using the data we used to estimate the parameters. And this is out of sample. Once we fixed everything and then rolled sort of in real time through new data that the model had never seen before. And each of these lines represents a different model specification. The only important thing to note is there's a ranking of models, green, red, blue, which is identical in sample and out of sample. And as a modeler, that's one of the key things you want, which is whatever you're fitting, its performance in the sample is the same as its performance out of the sample, relatively speaking. You'd be really scared if it sort of flipped, okay, because that is an indication there's something unstable. You found something in one data set, but it's not reflected somewhere else. And this tells you already that the kinds of models that we're using are extremely successful in fitting the entire distribution of the data, not just the tails of say a normal distribution, but also the dynamics over time. Okay, and there's this exact ranking, and in fact, the best models we have in sample are relatively speaking even better models out of sample. Okay, and so these fits more negative is better, and you should have sort of a 45-degree line downward. These are scores that we use to decide whether a model's a good one or not. So relative to some traditional models, these are sort of existing models, relatively simplistic models that people could use to fit this data. Our specifications provide a dramatic improvement. How important are things like announcements? So here's estimates of announcement effects and digestion times. So how long does it take, so these are 5-minute periods, for news to be digested? Okay, or put differently, what are the most important announcements for understanding aggregate equity returns? Monthly employment reports, right? It's not a surprise last Friday when the employment report came out that the S&P dropped 40 points almost instantaneously. It was a weak report. But then everybody looked around and realized, oh wait, this means the Fed's not going to be doing anything, and we end up going straight back up. This is exactly what tends to happen. So the units here, unemployment report, the 5-minute period after the report is 5 times more volatile than a normal 8:30 a.m. period return. Monthly employment, FOMC, Federal Open Market Committee, the Fed, GDP, first estimates of GDP, inflation, durable goods, jobless claims, and so on. Okay, and then you can see very quickly these things don't really matter anymore, don't matter much. So you often hear ISM services, ISM manufacturing, those were last week. You'll see a lot of coverage on CNBC about these things. At the end of the day, they're not really very, very important. There's really only a handful of things, which does beg the question of why is it that a lot of these macro announcements don't seem to be affecting things. You can decompose variance. That gives you the same story. Announcements explain a shockingly low fraction of movements. So if stocks aren't moving due to news about the economy, what are they moving? What's driving them? It's clearly not sort of macroeconomic news. I just want to show, I got about a minute left, show a couple pictures of this sort of ex-post accounting you can do inside the model. So here are, in May 2007, S&P 500 futures prices. You can see the returns here. This is total volatility. This is all 4 of the components. First component, second component, sort of these crashes or jumps, and then the seasonal effect. And you can see this week there was one big abnormal event identified, which turned out it was when Greenspan, maybe a little bit early here, said that China is clearly unsustainable and a dramatic contraction is on its way. Let's look at what happened during the crisis, Lehman Week. So most people don't realize stocks ended up from 6 p.m. Sunday night to 4 p.m. Friday, up for the week. Everybody talks about how horrible Lehman was. Wasn't really that bad. Stocks were up that week. If you start at Sunday night at 6 p.m. Okay, you can see these dramatic spikes in volatility. This is total volatility, which were driven by this fast volatility factor. The units here, this is 5, 10, 15 times higher than it normally is. That's the sense in which it was kind of or it certainly was a very volatile week. I want to show one more thing before I'm done. This was the TARP vote failure. You get a similar effect. This is sort of a metric of how unexpected things were. Here was a late October move. The S&P went up nearly 100 points in a little over an hour. But if you notice, the unexpected components of this explain nothing. So these abnormal movements, it was just that volatility was so high, which gives you sort of a glimpse into really how nasty markets were when the market could move up from 850 to almost 950 in an hour. And that's not necessarily an unexpectedly large move. I want to show one forecasting result, which is, I think, the real benefit of using a lot of this high-frequency data. If you want to predict how volatile markets are going to be tomorrow, and we've done it for other time horizons, you can explain about 75% of the variation in volatility using a model like this and high-frequency data. Okay? And if we think that getting a handle on uncertainty and how uncertain and volatile markets are is important for investment decisions, for risk management, for lots of different reasons, this tells you the value of this data. Using lower frequency or more traditional measures, you get about a 50% improvement off that. Okay, so it does take a lot to do this, but you get a huge improvement. We hadn't seen any numbers in the literature above sort of the upper 50s or mid to upper 50%. So you do a lot of work to get this, but there's a real benefit. And here's some pictures of looking at predictive tails. And this is how well do you do in forecasting tomorrow's volatility. This is how well do you do in fitting the tails of the distribution. People often care about extreme losses, and these models are very useful for that. And they end up hitting the target quantiles sort of right on target. So if you ask a question like, how often am I going to lose a given percent, or in a given day, how often I'm going to lose a certain amount, the model matches up almost perfectly with what actually happened throughout this period. So I'll stop there. If you want to read the work, there's some of it's been published, there's some of it on my website. You're happy to do it. It's a little bit boring. But at the end of the day, there's this debate about high frequency and what's going on. And while people often sort of narrowly focus the issue on really the microstructure, the millisecond and microsecond things, there's other large tangible benefits to all this automation. And I think it's a very active area of research, and it's a very fruitful area in part because of these big global developments over the last 10 or 15 years, which have made international events more important. And at the same time, we have markets operating overnight and at these different frequencies.